Welcome to We Build Great Apartment Communities, the only show dedicated to the process and strategies for transforming apartment buildings to thriving communities. I am your host, John Brackett, and welcome to the show. Welcome to another great episode of We Build Great Apartment Communities, the only place where you come to learn how to take apartment buildings and turn them into amazing communities. I have here another great guest. His name is Matt Brawner, and Matt's someone who's been at this now for, since 2010, and apartment buildings for, close to, I think that Matt about 8 years now, right? And so
it feels that long. Yeah, it's been a little bit shorter, but this is a business you do in dog years. So
yeah, it feels like
it adds up quick.
Yeah, it really does. It really does. Well, hey, bud, I want to welcome you. Excited to get into this conversation. So Matt, tell us a little bit about yourself, your story.
Absolutely. Well, John, thank you so much for having me on the podcast. I'm really excited to be here. My name is Matt Brawner. I am in Minneapolis, Minnesota. I live here with a beautiful wife and 3 kids. Was fortunate to start in real estate back in 2011. Never thought it would grow to what it is today. And all I could think about was townhomes at that time, my partners as well. And we were just blessed relationships over a period of time. And I actually left the Twin Cities after we started the company, went to work as a professional fundraiser, ended up down in Austin, Texas, thought that's where I was going to spend the rest of my life. And then the company continued to grow, and I just had this calling to be planted, to work, worship, and play all in the same place. So my family and I moved back to the Twin Cities in 2018. I had left the W-2 job, real estate full time. And now this is what I do every day. I tell people that my job is 3 phases. It's find money, find deals, and write process docs so I can spend more time on 2 items there. My staff can take of everything else. We're blessed to have about 2,200 units now, and that includes some passive investments across mainly the Twin Cities and the Mid-South region. We've got some stuff out in Las Vegas as well, but we're really focused on the Mid-South and the Twin Cities.
Awesome, bud. Awesome. So you said a couple of things that stood out. One is you're doing this full time, right? 2 is 2,200 units now since when you started. So what has been maybe, 3 things that have transpired, okay, during that process that when you look back, you can point to and say, you know what, these 3 things have really helped me build momentum to where I am today?
Sure. Well, I always want to say it's not me, it's we, because I've got 5 other partners who are, even though they don't do this full time, they hold as much of the responsibility for our success as I do. So it's been those 5 men that I've been on this journey with. Second of all, it's been just a willingness to talk about what we do, because that's blessed us with some incredible relationships. We met one operator in 2015. He was putting together some really attractive deals in the Twin Cities. We were fortunate enough to have capital at that point in time, and we got to come alongside him as a true joint venture partner that helped us build credibility in the broker community. And then it was through those joint ventures that we began to network, met other operators, and ultimately found networking relationships that took us down to Memphis, Tennessee, in the Mid-South area. And that's really where we've seen our business grow significantly since 2019, and where we've moved away. We still have our management company where we will manage units that we own here in the Twin Cities, but have seen different opportunities to scale by bringing on other team members, like a property manager specifically, who can take on what they do best and allow us to find more opportunities for ourselves and our investors.
Okay, cool. So let's talk a little bit about that, right? So in your language, a lot of things that I hear, you really talk about networking and working as a team, which in every business you need teams to scale, right? Mm-hmm. In every single business you need teams to scale. So talk a little bit about the networking opportunities that you find yourself focused on today, based on the experiences that you've built up to this place, because you mentioned a lot about networking and the importance of that, right? And some of the investment opportunities that you're able to find and now place yourself in as a result of that. And so are you still networking today? And then, of course, what does that look like?
Absolutely. I actually have a task on my task list every Tuesday that I view, it's just a spreadsheet, all of our investors and all of our real estate connections, because my worldview on this is that you need to surround yourself with as many smart people as you possibly can and then provide value. So I'm always looking for excuses to get back in front of people. We certainly attend meetups and all the other professional opportunities that come our way. We go to conferences, but I look for opportunities and excuses to go out to lunches with brokers, to check in with my investors face to face, to speak with property managers when I'm going down to Memphis, whether it be to look at a new opportunity or just to check in on our current assets. It's just the framework that I have. And I haven't, had a large platform. I've been blessed to be on a podcast where, I've people, but it's just been through referrals and trying to provide value to those that I come into contact with. One example that I provided people, the first time we invested as a passive investor, wanted to build a relationship with the sponsor. And so we were providing referrals, helping them fundraise. And we didn't ask for anything in return, but we knew that if we provided value, that would come back to us in spades in future opportunities, and it has.
Okay, awesome, bud. I appreciate that. So let's talk about strategy for a little bit, right? I appreciate the background, some of the insights around marketing and how you came into some of the opportunities that you have today. But let's talk a little bit about strategy. So what is your strategy moving forward today? I mean, what are you folks focused on? How, why?
Sure. So actually picking up on the conversation we were having before we got started here, like you, I am really focused on growing metropolitan areas. Apartments are pretty basic. People paying rent. It means we need population bases that are growing. Paying rent means we need people who have jobs. So you follow the jobs, you find the right tenants. The Mid-South has seen good population growth because people are voting with their feet, and the population of the country is generally moving south right now. But then we've also, specific to Memphis, what we've liked is we had a business case built around the fact that it was this boring little town, and it still is, but that being centrally located, it would grow with of e-commerce because of FedEx, having access to the port along the Mississippi River there. It's a transportation hub, and that would bring people who needed jobs. Specifically there, we are really trying to focus on B and A class assets because what we had seen is that cap rates were relatively the same across asset types. And so then if you can trade into a higher asset classes and trade out some of the headaches for more stabilized cash flowing properties, that it is a better opportunity and you're getting a value for you and your investors.
Yeah, I really like that. So can you elaborate on that a little bit? Because I think that makes a lot of sense. And, I see more and more people doing that, but I like the way that you've articulated that. So for our listeners, can you explain the risk logic there, right? So if you bought it, if cap rates haven't changed very much, in this case, I see, depending on the market, cap rates even compressing a little bit, right?
Right.
So if you're looking to trade up into, a similar cap rate, larger asset, the risk logic there is that, hey, you're not taking on more risk, right? You're effectively maybe taking on less risk from a tenant profile standpoint, right? And ideally, you're likely going to run into less headaches when you're managing the asset, right? Because of the tenant profile has changed a little bit for the better. So can you elaborate on that a little bit?
Sure. So I think for listeners to understand, there's a couple of basic truths that I would offer in terms of how I think about this trade. First of all, bigger isn't better for bigger's sake, but what we see in apartment communities, as you see larger assets, that means more stabilized. That means you can manage them to a budget. That means more predictable cash flows. Ultimately, for you and your investors to be able to anticipate your returns. What we see in smaller properties, or I'd seen it frankly in a lot of my C-class assets, the P&L just has a lot of volatility, a lot of noise. So being able to trade up for that while well, paying the same multiple for a more reliable income stream as an owner, that's really attractive to me. And then when we talk about, a better tenant profile, we're obviously not commenting on of people, but what you do see as you get into C class assets, people can get excited because maybe they're able to buy in at a lower basis, but those tenants are going to be rougher on the units. And when we talk about tenants being rougher on the units, being more expensive to manage, ultimately the only value that comes from real estate is the value of the land. Everything else is how you run a business. So your expenses going up with C-class assets and those operating at a higher expense profile means that those assets are going to be more difficult to sell, that you're going to have a lower value there. So if I can get more predictable cash flows that are going to operate at a lower expense rate, and then just provide better peace of mind for myself and my investors, well, then that's really attractive to me. And that's the value that we're pursuing. And there's a lot of smart economists out there, who have degrees much more sophisticated than mine that can explain this better, but I just believe there's a lot of energy around multifamily right now. As if we are in an inflationary period, you're going to see people really flocking to hard assets, and so that makes, all right, people are excited about multifamily period. Let me make sure I'm in the best area of it.
Yeah, no, I would agree with that. So let's talk a little bit about, you talked about B-class assets and the fact that your income statement to a large degree is going to reflect, I think you used the word noise, right? Some of the volatility with C-class assets, and I like that. So, with B-class assets, especially if you're in a metro, in theory, your expense ratio a little bit lower, especially if it's a newer product, right? A newer product or a newer build. So what are you pursuing right now in terms of vintage, or are you predominantly focused on location?
Predominantly focused on location, but all things being equal, we would like to be 1980s or newer. There, 1980s, 1990s. The reason we look at that is there is still housing stock that can be refurbished, so I can create value, right? Value comes either from when you buy or from what you do to the asset. And that's important for the markets that we look at. Is there housing stock available that I can refurbish? We have gotten into some 1960s and even older, but it's just because of the high quality of the market there. And that's candidly something earlier in my career I had really shied away from because I got burned pretty bad when I was getting into some duplexes. And I just had this idea that, all properties operate the same. I was so naive and had a really poor approach there. But then as I graduated, learned to be more focused on a specific property type. However, we feel confident in going after some of this older stock now because of, one, the strength of the local market, not just the city, but the actual zip code and the neighborhoods that we're in. And then it's just making sure that you have the reserves and specifically the cash to be able to fund any renovations to upgrade the mechanical systems that you need. Okay.
And when you talk about mechanical systems, are you talking specifically about HVAC, or can you elaborate on that a little bit?
HVAC, more important, is going to be plumbing and then especially electrical. One of the most volatile markets out there right now is the insurance market for multifamily. There's carriers that are just refusing to write policies in certain areas, specifically like tornado-prone areas. And so whatever you can do to mitigate their concerns ultimately reduces your premium and improves your P&L. And so one of the things they're really looking for, has all the electricity been updated to copper wiring, right? Is everything, depending on how old a stock you're looking at, is everything on breakers there? So there become some key dominoes that can affect the profitability of your building just based on the mechanical systems.
Okay. So let me ask you a couple of questions. All right, Matt. So you're right. Insurance, a little bit more volatile probably over the last 2 years. Mm-hmm. And a lot of that is location driven, right? The more volatile the weather, usually your premiums are getting hit as a result of that. So when you're pricing opportunities during the acquisition phase, depending on the market, one of the things that I see is taxes, insurance, usually the two bigger numbers. Does that hold true for the markets that you're buying into as well? And do you have any strategies around, how to better either manage that going in, or when you do acquire to reduce that after the acquisition of those assets?
Sure. Well, I like to remind myself that you never get back what you lose on the front end. So the best strategy is to go in with conservative estimates. And one of the strategies that we've used in the markets is we've just found good sources of truth for those two specific items. We've got an insurance agent who focuses specifically on the Mid-South. And we do, get competitive quotes just to make sure we're fulfilling our responsibility for our investors. But he's been just really fantastic to work with in helping us predict, from a conservative standpoint, the type of premiums that we will likely be seeing with a property. And then along the same side, we've got an ad valorem tax attorney. So he's someone who he gets paid when he goes to fight your property taxes, and he gets a percentage of those. And because we've provided him with enough business, he's willing very quickly to help us. He knows these properties sometimes intimately because he may have worked or currently works for the seller to help us anticipate if we provide where we think the property is going to trade at, what our property tax liability could be. But you're right to really focus on that, and property taxes in particular, because it's going to be different market to market. Even my own two markets up in the Twin Cities, things get reappraised basically as the assessor has time, and he's looking at all the sales that are coming across his desk. Other markets like Memphis, they reappraise every 4 years. So you're not necessarily timing the market, but you have to be aware of the fact that you may be in a reappraisal year. To be revenue neutral because they'll raise the appraised value and they're supposed to drop the mill rate, but they don't always do that. So your anticipation of any trends and where you fall in that cycle is really key to setting your value.
That's really interesting. So appraised value goes up, mill rate goes down in theory?
That's the way it's supposed to go. Doesn't always happen like that.
Okay. So, here's something that I find interesting. I'd really be curious to get your feedback on this or your comments on this. But, we've gone through with COVID kind of an interesting scenario, right? Where we've, as a country, we've given out a lot of dollars to help mitigate against just a lot of the economic stress that we've been under as a result of COVID, right? A lot of benefit has gone out to the communities. And so now we're in a situation where we're starting to come out of that. We have a lot of money out in the marketplace. There's talk of inflation. Heck, I even see it. You probably do as well, right? In a lot of the buying activity around us. But inevitably, the government's going to have to find a way to start paying back, right? These dollars that have gone out. Okay? Just has to happen. So one of the easy ways that I see that, of course, is through property taxes, right? Because it's really as easy as an assessment, especially if you already have a rate that's built in. So one of the things that I'm seeing is rates going up, and oftentimes when people are buying, me included, the assessed value is being fully grossed up to purchase price. Right? Even if you're in a non-disclosure state. So can you talk a little bit about that? Because I see that becoming, I don't want to call it a big challenge, but I see more speed picking up there, and I'm already seeing that now. So over the next probably 2 years, I think we're going to see a lot of tax increases, and I'm already seeing that now as a way to make sure that cities, right, are able to recapture some of the money that's gone out as a result of COVID.
Yes. The short answer is taxes are going up. The government has spent a lot of money, and they now need to recoup that. And especially at the state level or the local level where property taxes are assessed, that's really important because unlike the federal government, state and local municipalities are required to balance their budgets. So they have to go find that revenue. And I think the first place that we're going to see it is in property taxes. I think then we're going to see it in the cost cost of goods, as sales tax, and other ad valorem taxes continue to increase as well. I commented earlier that I think the population is shifting south. A lot of the states in the country that don't have an income tax are in the South. Now, it's great because we're seeing populations grow, which means tenants paying jobs can pay rent, but they're also being stressed, they being these local municipalities, right, that don't have income taxes. So they need to be able to find the funding to support these populations' growing demands on their infrastructure. And they're going to get that from property taxes. I used to live in Texas. Texas loves to trumpet the fact that they don't have an income tax. And yes, that was great. I was still working my W-2 job when I lived in Texas, and I actually moved from Ohio. My pay went up, but I bought my first house in Texas, and goodness gracious, I had to a drink the first time I got my property tax bill. So there's no free lunch here. The state still gets their money. Right. Your mention of COVID, actually, the thing that I watch, and I'm probably more concerned about even than taxes and inflation, because I think we've got a little bit of a hedge, as I said, being in a hard asset. But it's watching how people are responding to tenant laws that were in place, all these eviction moratoriums that were there, even in, again, a place like Texas, right? They have changed. They've become more tenant friendly just to follow the current political headwinds of the time. And I'm not trying to, make a political argument about this one way or the other, but, I'm not someone who's, yay evictions, so I can push people out on the street. But when we talk about evictions, that is fundamental to our ability to operate these properties. And it's something that people get in when they look at markets, is they don't understand how easy or how difficult it will be just to enforce the contract that they've established with their tenants. So I know I was bridging a little bit there, but those are the two things on my mind: is property taxes and where do landlord-tenant laws go following COVID.
Yeah, that's really interesting, man. Very, very interesting. So what has been the biggest shift that you've seen since March of 2021 versus where we are today? And this could be, anything, right? So if you look at the cycle of an apartment building, acquisition, finance management, disposition, where have you seen some of the biggest shifts as a result of kind of the environment that we have just transitioned out of? And technically, I guess we're still in.
Sure.
Doesn't feel that way, but I guess we're still in.
I think there's a date that everyone likes to ascribe to COVID because it's the date that Tom Hanks got COVID, and that's the date the world truly lost its mind. I think that was like March 12th. So if you would have shown me my financials on March 11th and then showed me my financials 3 to 4 months later, I may have said, what's the big fuss? I don't see anything here, right? Because we were lucky that tenants were still prioritizing rent. Yes, we had seen collections slip slightly, but it certainly wasn't the 20% that everyone was fearful of at the end of March last year. I think it's been the external pressures that I've seen change the most. Going back to landlord-tenant laws, as you see national and local politicians talk about the whole gamut of rent control to eviction, to even how property owners are taxed, I think has been a change that I've seen. President Biden's pushing through a $4 trillion infrastructure plan, and he's got real estate people right in the bullseye right now. And then the other piece has been inflation and what we've seen in the cost of, we haven't done a lot of projects that involve lumber, but costs of drywall and as of late, just how difficult has it been to find labor. I'm hopeful that as more states pull away from these unemployment benefits that we'll see that shake loose. But that's what comes to mind when you talk about what's changed during COVID.
So you brought up something that I think would be a great topic. So I'm going to touch on that a little bit, and that is the infrastructure proposal that is building right now, right? And the whole idea about deploying an additional, in this case, $4 trillion. We just deployed close to $3 trillion, right, to get us to where we are today in the economy. And now we're looking at another $4 trillion, and this is all infrastructure related. So there's for sure going to be either a opportunity that comes, right, that rides that wave. And I think there are going to be some specific markets that really capture the benefit of that. what are your thoughts on that? Obviously, everyone needs housing. And, as you start to move throughout different states to be able to bid on these projects and start on these projects, right? Housing is going to be, I think, a pretty good component of that. But the other side is, we're going through some things right now that in discussion could also potentially negatively impact real estate as well, right? Because of some of the conversations that are happening right now with this administration. So without getting too political, but that's not the intent, but we can't neglect the fact that politics just affects how we do business, right? It may not affect how we do business, but there's usually some economic impact because of the political decisions that are made. Our job, or my job, I always say, is to figure out the opportunities as a result of that. So what are your thoughts on that, right? I mean, we're getting additional dollars, and these aren't small dollars, but trillions getting ready to be deployed in infrastructure projects. Pros and cons.
Sure. I think like you, we're learning more every day. We're looking at plans right now. There's no actual bills being considered. But I think one of the cons, and the thing that has me the most concerned, is I believe the infrastructure bill, with the way they want to fund it, is going to stress the housing markets further for a couple of reasons. One of the main things that's catching people's eyes is effectively getting rid of the 1031 exchange. You'll still be allowed to do it up to $500,000 gain, but that will significantly reduce. And as you look at their projections and what they're saying they're going to make in tax revenue, they assume, they being the Congressional Budget Office that is putting forth these proposals, that the transaction volume will continue at its same level, which I think is very foolish, right? If you are showing people an increased cost, I think then you're going to slow down the transaction. So owners are just going to hold longer, right, to avoid an inevitable capital gains tax. And that is really troublesome, because we know that when properties turn over, they get refreshed, right? This is an opportunity to improve housing stock. Tenants get better places to live when properties turn over. Just because somebody owns it right now and they could increase rents if they've owned it for 10 plus years, there is no financial incentive for them to redeploy more capital into the property there. There's also a huge detriment to state and local municipalities, because it's as properties, even if they are on, there's this foolish idea out there that the 1031 is just a giveaway for the rich. And there's actually data that shows that it is not the mega rich that are taking advantage of this, because it keeps transactions going. And then what happens when real estate transacts, as you just pointed out, well, property gets reappraised. There's more tax dollars that get put into the local community. Property stop trading, you're not going to be able to reappraise there as well. And so as I just reflect on it here, I do have some deep concerns about what it'll do to the ability to find housing for all classes of people. I do believe in what you said, though. I'm a believer that there's always the opportunity to make money, and we will respond. I believe some change is inevitable here with President Biden in terms of what actually gets enacted. We'll still see. I tell my investors, and when people ask me why I'm in real estate, I do believe that if we see $4 trillion spent, I think you're going to be very good to be investing in a hard asset. I would not want my money personally in the stock market in that type of inflationary environment. So that's just kind of what comes to mind as I think about your question.
Awesome, bud. Well, I really appreciate having you on, man. Well, Matt, we are approaching the end of our show. It's been great speaking with you. You've been a very gracious guest, especially as we just covered the gamut, right? I mean, we've talked about a lot of different things. And I think more importantly, you've been able to share that information in a way to really help our audience see this business from a couple different vantage points. And I think there's a lot of value in that. So I want to thank you for being on. Again, you've been a very gracious guest, and, I want to wish you continued success. What is the one question that you have for me, Matt, before we ask you to share how you can get in touch with or how our audience rather can get in touch with you?
Sure. Well, John, I just really appreciate you having me on the show. I would just be curious, what are the things you get to talk to a lot of great operators, present company excluded, but what have you learned? What sticks out to you from all the guests that you've had here? What are some of the key themes that you've taken away in your time doing the podcast?
Yeah, that's a really great question. And the thing is that evolves, man. The thoughts that come to mind are very different today than they were a year ago. And of course, I think that's just a function of how the market is changing and evolving. But if I had to put my hand on just a couple of core qualities of operators, just core qualities, I think maybe that would be a better way to answer that question. It would be, I think there's a shift a little bit more towards strategy right now, right? Resiliency is always going to be a part of that, but I think what I'm seeing right now is seasoned operators are being a little more strategic with their capital, and of course, I think that the logic there is maybe playing defense a little bit with investor capital. And I think you gave a really good analogy of that with the trade up, right? With assets that are just in better locations, right? Less risk. I think that's a really good analogy. I think the other side of that too is always remaining open to exploring venture opportunities with other operators, right? I think as markets start to shift, whether it be there becomes more risk out there in the markets, especially in the markets that you're operating in, the markets become more competitive. I think the best business people, I'm not even going to use the word operators, but really the best business people find ways to innovate. And I think great innovation comes through really good collaboration. So your comment around always surrounding yourself with very smart people, I think that is going to be very useful in markets like this and going forward, right? Because, two minds are usually better than one. At least I can speak to that as a truth for me, right? When I'm collaborating with other people, I just get very different insight. I think lastly is, and I see this is kind of the third cycle that I've been in, really the fourth, but I always say that efficiency is created through specialization. Right? If you focus predominantly on apartment buildings, you get really, really good at underwriting and identifying apartment building opportunities, right? So you become more efficient. But I think it is important to understand how to look at different product types or different asset classes in this marketplace, and how to identify opportunity outside of this dimension or this class. For a couple different reasons. And I think that if I can speak to this, I'll speak to it this way, right? And I underwrote a deal, and it really comes down to the opportunity cost of capital. Okay. That's kind of the summary, but I was looking at a deal, and this is kind of common, right? So over the last 2.5 months, I probably have looked at almost 200 deals, made offers on 8 of them. Okay. But one of the things that I'm seeing is a lot of the sellers are expecting to sell at a price that accounts for some of the pro forma profits as well.
They want credit for your work.
Of course. And look, there's nothing wrong with that. I do that as a seller too, right? Yeah. So I never complain about it. Again, I'm just looking for the opportunity, right? So if the market is taking on that form, meaning you have more sellers that are able to command that just because of demand, then my question is always, okay, well, if the market is pricing a 6 cap 3 years out from today, then if I have another opportunity that's presented to me, this is really common right now. I'm looking at these, right? A triple net lease, right? A true net lease. Absolute net, 6.8%, okay, with a national credit tenant, 10 years remaining in the lease. Really good deal, actually. And I had one that was similar to that, where it was a pawn shop. Okay, made offers on both. One of them I'm likely going to buy, larger building, okay, retail building in a really good market. Really good example, right? So why would I take 3 years to chase a 6% cap rate and take on all of that risk when I can deploy my capital today, right, and get a net 6? Now, granted, I'm not going to get the leverage that you do in 100 units, right, over the course of 5 years or 6 years when you can bump rents. But again, man, the opportunity cost of capital, if I value my time and energy and I'm really looking out for my investors, those are the things that I think about. And I think money is starting to make that shift. I think that's why you see, demand for industrial product. Just one of the reasons why it just ran up, months ago. Because people are smart. They're going to start looking at that stuff and going, well, why? Now, why would I take on all that risk when I can park my money here with half the effort for the same return? So those would be really the three things, to answer your question.
Sure.
But it takes effort, man. I mean, nothing great is easy, it just takes a lot of effort. And I think one of the awesome things about this business is just the opportunity every day to learn. And a lot of that comes from just meeting some great people and getting exposed to great ideas. But, the reality is the more deals you look through and underwrite, the more I think you see things for what they are and sometimes, for what they're not.
Right.
I just hope I'm not stuck in a deal when I buy something and I forget to see something for what it truly is.
Right.
Well, hey man, I want to thank you again for being on. You've been a tremendous guest. So, how do people find you out there, Matt? What's the best way for people to find you?
Best thing to do is send me an email, matt@nwsproperties.com. N as in Nancy, W as in world, S as in Sarah, properties, all spelled out, .com. Or you can find me on LinkedIn, Matt Brawner.
Awesome, buddy. Hey, thanks again, man. I want to wish you continued success. It's been really a pleasure, getting to know you and having this conversation with you and just learning how you do business and how you're looking at today and also, the future a little bit. So, Matt, I want to wish you continued success and look forward to staying in touch, bud.
Likewise. Take care, John.
Thank you. Clarity of purpose creates our greatest competitive advantage. When we transform apartment buildings to thriving communities, we improve how people live and create assets with high profit margins. Don't forget to subscribe, like, and share this up with a friend. I'm John Brackett, bringing you things you can implement right away.